Hey folks, it's Simon here with your Tao Daily for Monday the 24th of February 2025. Markets had a pretty heavy sell-off on Friday. No sort of one kind of smoking gun. It just looked like a cocktail of fairly negative things. We had consumer sentiment drop unexpectedly. Inflation outlook hit the highest they've been since 1995. Housing data has been pretty weak. Servicing PMI dipped back into contraction. We had Walmart's kind of aftershock. Walmart dropped 6.5% Thursday following disappointing guidance. It was down another 2.5% on Friday. Retail sector is underwater. This is a negative sign for the US economy, with retail plunging over 3% on Friday, well below the 200-day moving average. We had a China virus scare, which kind of added fuel to the fire. So all in all, Friday was a pretty rough day. Couple of other interesting charts I want to share with you here. One is the skew. The skew is at record highs, or where it was last week. And if we zoom out a little, you can see what I mean. It was at record highs last week. What that means is the cost of out-of-the-money puts relative to calls is as high as it's ever been. It reflects growing demand from portfolio managers and traders for insurance against a sharp market downturn. All right, because it's comparing the price of put options that are 2 standard deviations out of the money. So it's showing the cost of so-called tail risk hedging, or hedging a black swan. So demand for that, like I said, it's gone for the roof. Now, this does not guarantee an imminent crash, but it is a sign of nervousness. Another sign of nervousness is this one. Now, this pink line down the bottom is the US Economic Policy Uncertainty Index. What you'll notice is that we've got it's spiked recently, all right? And that's presumably as a result of tariffs. Now, the last few big spikes we had, there was one during COVID, there was one during the global financial crisis, and there was a spike back here during 9/11. And what you'll notice about these price spikes is that they were coincident with market declines. Obviously, the COVID one was short and sharp, but 30% decline in 2 months was pretty sharp. This spike here is coincident with a market that is kind of chopping sideways at all-time highs. It's a small data set, but it does reflect increased nervousness, and it's a sign just to stay on your toes. Now, there's nothing like innately bearish here about the S&P 500 chart. One thing I don't like is this false breakout. All right, you get a false breakout, price jumps above the previous all-time high, only to close back below it. That's often a negative signal. But really and truly, the S&P 500 here has done nothing since late November. So really, we've been chopping sideways for 3 months now. If it came back down and retested the bottom of this box, I think that could be a very interesting technical buying opportunity. That's what I got for you today. I hope it helps, and I'll catch you next time. Thank you.